We're starting to ask, is this as good as it gets? And that's from two perspectives. Firstly, growth, and secondly, policy or politics. In terms of the economy, it looks like the surge in momentum we've been talking about in recent months has probably peaked. I think the growth rate looks fine. Higher inflation is good, but it's going to cut into consumer spending power, so we'll probably see some moderation. In terms of policy, we're looking for diminishing monetary policy support as the economies normalise. This is not just across the US, but also in many developed markets. Europe and Japan even probably going to be signalling a tightening before the end of the year. So the era of zero rates, abundant liquidity, it looks like that's coming to an end. I think that's a good thing. It reflects the macroeconomic improvement, but it's a very different environment for investing. We're also probably around the peak of policy optimism under Donald Trump following the failure of the healthcare bill, which means dramatic tax reform is going to be difficult. And maybe also a peak of political optimism in Europe. I think people have realized France is going to be okay, but once that's out of the way, we have to turn to Italy, which looks much more problematic. Now, we're not suggesting a recession. We're just saying the optimism on macro drivers seems to be peaking, and it's hard to see now where the next positive surprise is going to come from.
After a month of no net new movement in US equities, it is becoming clear that there is a tug of war emerging in the market. On the one hand, there is the view that equity valuations might be too high, and perhaps some other classes as well. And on the other, there is the view that strong economic growth will conquer all and keep driving markets higher. On both fronts, the jury is still out, in our opinion. Earnings thus far in 2017 look solid enough, and as the growth outlook. Even so, we remain worried that markets are pricing in a scenario that is too optimistic. With central banks in tightening mode and the cycle getting on a bit in years, it is realistic to expect some moderation from now onwards towards the end of the year, certainly from a point of view of growth. At the same time, credit spreads are also looking a little bit stretched as the benign economic environment has driven down default rates to levels close to historical lows. This makes asset allocation quite tricky. Across the risk spectrum, most assets have potential valuation challenges. It is for this reason that we still refrain from adding additional risk to balanced portfolios. Credit exposure is still an overweight, given that it pays a reasonable yield for a contained degree of risk. Equity weights, on the other hand, we remain underweight, reflecting our bias towards the argument of high valuations. It is for this reason too that emphasis is being placed on rotation strategies, looking for assets that have run ahead more than others and replacing them with ones that have lagged and still possibly offer better value. As a final point, we note that some of the event risks that we have been highlighting, that we have been concerned about, are receding but not disappearing. As a result, volatility across most asset classes remains very low and is offering a way for investors to take out insurance at a reasonable cost.